Well, good morning everyone. Welcome back to my channel once again. Today I'll be discussing the idea of managing active risks in your investment decisions and when that might be something that will contribute to your final decision on individual investments or your total portfolio management. So let's get straight into it. Of course, none of what I say can be taken as individual personal advice, and I kind of feel the need to address this right from the get-go, given a comment that I received in response to my most recent post. One viewer commented, "Hi John, are you authorised to provide financial product advice? Do you hold an Australian Financial Services licence, or are you an authorised rep of the holder of an AFS licence?" Well, the answers to those questions are no, no and no, and that's why the content on my channel is now general in nature, with no reference to any of my trading activity, portfolio structure, current scans or back-tested strategies, which was the case when the channel was titled Invest for the Future. I am relying on my interpretation of section 911A(2)(EC) of the Corporations Act, which permits video content that is intended to provide factual information, not financial advice. ASIC, however, has unfortunately blurred the landscape, and it seems that they are taking the view that even providing current information about the absolute value of and changes to debt levels, growth rates, profit margins, and published forecasts of the outlook for a company could be considered as financial advice. Now, I'm of the view that my current content could not be interpreted in that way, and the additional content provided to my patrons has also been noticeably modified to ensure that I'm staying within what I think are acceptable boundaries. But that's just my view, not tested in a court of law. Now, managing risk is just a part of everyday life for everyone. Right now, it seems that I'm one of a very small minority who's choosing to still wear a mask when shopping, either in supermarkets or in retail outlets. Most appear to accept the risk of catching COVID or the flu. But my mother has impaired breathing, and as I see her regularly, I need to reduce the risk of me passing on a respiratory virus to her. You know, whenever we eat, we all risk consuming contaminated food, but that risk is so low that we don't even think about it. We all subconsciously assess risk when we're driving on the road, but given the number of accidents, perhaps it should be a more conscious assessment. As far as investing is concerned, Stock Doctor filter the total market down to a small universe of stocks that they think are investment worthy, and for each they assess the active risks that need to be considered when deciding whether to invest. For example, they describe the following range of active risks for a well-known company. Risks that their research and development spend, which is quite large, could prove to be unsuccessful. The risk that several other strong competitors in their space could erode their market share. A senior member of the management team is leaving, and will they be able to adequately replace him or her? They've made a recent acquisition which has increased the debt level for the company. As its earnings are mainly derived overseas, there is currency risk, and any changes to government regulations could impact on their business model, along with the fact that it's currently involved in several legal disputes. And there are others, but I hope you get my point about the need to weigh up those risks against the prospects for the business and decide whether the current share price offers enough upside reward to kind of balance out those risks. Now, Stock Doctor has decided that the risks are acceptable, but can provide no guarantee that the stock will trade higher in the future. In fact, quite a few of their star stocks have not been performing well of late, and just because Stock Doctor thinks these companies will survive the current downturn in their share prices does not make it a fait accompli. On the other hand, some companies, also with a range of active risks, have been performing very well. And so, as always, it's the total picture that eventually counts, and having a well-diversified portfolio of quality companies should mitigate portfolio risk. For those who advocate that you only need to be invested in a few companies, I would just say that I don't agree. So far I've been talking about investments in which company structures and financials and the competitive landscape inform the decision-making process. But for those who choose to use charts and technical analysis only, risk is more about deciding how much you are prepared to lose before exiting an individual position. This is probably weighed up against a profit target that may be apparent from the chart and preferred overlays such as relative strength or perhaps some kind of moving average. But regardless of the techniques used, investors using this approach really should have some appreciation for the risks that they are taking. And the stats show that less than 10% of investors who decide to day trade make a profit, so the risk of losing is very high. I'll say no more about trading then, as I was terrible at it and followed one of my golden rules, which says if you're doing something and it's not working, then stop doing it. So just to finish for today, there's always risk associated with any investment. My general view is that if the risk you have taken doesn't let you sleep well at night, then the risk was too high. Can't put any numbers on it, but in my case, I can say that even if the stock market crashed by 50%, I would still be able to live my preferred lifestyle for at least the next 10 years. That's how I'm managing the risk of my investments in the stock market. Oh, and I forgot last week's challenge of trying to guess my mystery stock that was almost a 10-bagger over the last 6 years. There were only 3 guesses: Codan, Liontown Resources and Pro Medicus. At least that's at the time of recording, and one of those was correct. Now, Liontown has actually been a 130 bagger since September of 2016, but has never made a profit, so that one was quite a way off the mark. Codan, on the other hand, has been consistently profitable, growing its earnings almost every year since 2014, but not to the same extent as Pro Medicus. It has nonetheless been a 7-bagger since September 2016, so that was a very good guess, but not correct. I do think, however, that Codan is the perfect example of a company where the active risks are weighing on the share price action. Over the last year and a bit, the share price has fallen from around $19.50 down to about $8.50 despite revenues and earnings growing. It seems that the market is weighing up the risks around some aspects of its business, in the sense that 40% of its revenues are from gold detector sales to Africa, where political tension in Sudan is seen as presenting significant risk in the eyes of some analysts. But they are the opinions and the reactions of others. As an investor, you need to measure those risks, act on your own analysis, and be prepared to be wrong and have a plan to manage that contingency. Thanks for watching, and I do hope to catch up with you again next weekend.